The upgrading facility at TTI, we had to change it from producing a sulphate slag to a chloride slag. There's only 2 people in the world that provide a chloride slag. That's us and Rio Tinto. And we now have that operation is now very close to operating at that expanded capacity, slightly earlier than we had anticipated. It's pretty interesting technology we have there. There's only a few people in the world, Rio, Tronox and ourselves, that have that technology. But operating it for over 30 years now, that IP is critical to keeping it operating and having it operating as efficiently as it does. But I've actually got a little video to show you now, rather than to sort of keep going on about it. When you actually see how big this operation is, I present when I was at $40 million and I was presenting the same thing. It was a little frustrating, sort of presenting it next to some of the projects, but it's worth seeing. So let me show this to you.
Mineral Deposits Limited owns 50% of the Tizer joint venture in partnership with Eramet of France. The Tizer joint venture comprises 2 integrated operating assets, the Grand Côte Mineral Sands Operation, GCO, in Senegal, West Africa, and the Tizer Titanium and Iron Ilmenite Upgrading Facility, TTI, in Tyssedal, Norway. Over a mine life of more than 25 years, GCO has a nameplate production capacity averaging 85,000 tonnes of zircon and 575,000 tonnes of ilmenite per annum. GCO is the largest single-dredge mineral sands operation in the world. Ensuring control of product from mine to ship is central to GCO's cost-effectiveness. This logistics and infrastructure self-sufficiency starts with Yane, a large-scale mineral sands dredge with the ability to extract 7,000 tonnes of mineralised sand per hour. Moving through mobile coastal dunes, Yane extracts ore from the front of the dredge pond and pumps sand and water to the floating wet concentrator plant, which separates the heavy mineral concentrate from the lighter sand through a staged spiral gravity separation process. HMC is then trucked to the mineral separation plant. Within the Mineral Separation Plant, or MSP, the heavy mineral concentrate is upgraded and separated through a wet and dry circuit process. The wet circuit process separates minerals into magnetic and non-magnetic streams. These 2 streams are then processed in the dry mill, which uses screening, electrostatic and various stages of magnetic separation to produce the final products, being 2 grades of zircon, 2 grades of ilmenite, and small quantities of rutile and leucoxene. Our 36 megawatt power station at the MSP is capable of being powered with heavy fuel oil, natural gas or diesel, providing GCO with power supply security. Using GCO's own locomotives and rolling stock, we shift our product over 120 kilometres of GCO-owned or controlled railway from the MSP to the port of Dakar. GCO has its own warehousing and ship-loading facilities, as well as secure mole access at Dakar port. Once fully loaded, ships depart for delivery to off-take customers or for processing at TTI in Norway. Commencing ilmenite upgrading operations in 1986, TTI has a long and stable production history and is one of only a handful of such facilities of its type in the world, and the only one in Europe. TTI smelts ilmenite to produce upwards of 200,000 tonnes per annum of high-quality titanium products, which are primarily sold to pigment producers, and around 100,000 tonnes per annum of high-purity pig iron, a valuable co-product that's sold to ductile iron foundries. TTI's excellent positioning on the Hardanger Fjord, just off the North Sea, allows for year-round shipping and direct loading from the facility, enabling quick access to worldwide consumers. Managing GCO and TTI as a single, vertically integrated operation creates a number of important advantages for our business. In particular, securing offtake for a majority of GCO's ilmenite, ensuring long-term security of ilmenite supply for TTI, and providing the flexibility to produce either a chloride or sulfate-grade titanium-rich feedstock for key global customers. Each of these elements minimizes the risk of the combined business while increasing flexibility and optionality to respond to changes in market dynamics, thereby enhancing the potential financial returns. Both assets operate with a high standard of health and safety, environmental sustainability, and community responsibility.
It's a good way to do a talk when you put on about a 5-minute video. But anyway, and I think, as I mentioned to you, we've done a lot of work down at GCO and the operations to sort of get where they're going. We've sort of fixed the financial side of the business, but the other side of the business that's worth spending some time on is the market. And look, that's really started to kick in over the last 6 to 12 months. The demand side is largely taken care of in terms of the close correlation, if you like, between the prices of what are essentially go into lifestyle products. When you start looking at the very close correlation between global GDP and the pricing of our products. So demand is absolutely starting to take care of itself. On the supply side, we're starting to see shortfalls starting to emerge. So particularly when you start to look at zircon, the uptick in zircon in recent months or over the last 6 months has been quite extraordinary, really, as people have started to really recognise the shortfalls coming through and really questioning where the supply is ultimately going to come from. On the titanium side, a little bit different, where there was a lot of idle capacity when the markets got really tough, particularly Tronox and Rio, as I mentioned, the other two suppliers of a chloride slag. They've restarted pretty much all of that idle capacity, and we're still now at a point where all of the inventories all through the pigment chain are largely normalised now. So we're really starting, while we've seen it on the Chinese ilmenite side, we're really now starting to see it on the high-grade feedstock side as well. So as we go into 18 and 19, there should be some good outcomes to come there. From a Tizer perspective, where we are on our risk diagram, it's that overnight success when you sort of saw that the share price chart over the last year is interesting, but it's been a long 10-year journey, if you like, from the time where we got the concession back in 2007. Gone through all of the operations, spent $650 million building the mine, $70 million to convert the ilmenite facility into taking the GCO ilmenite, the refinancing of the debt, to finally now where we are positive cash flow at both our operations, which is fantastic. We currently at the end of this year have sort of $48 million sitting on that Tizer balance sheet, obviously alongside with the $300 million of debt from the new bond. So where do we leave the platform that we have for our MDL shareholders? Clearly, improving sector outlook is attracting a lot of interest. The value leverage in terms of what you see there on the share price graph, certainly from our perspective, there's a lot more value to be recognised. We've spent our money now. There's no money outstanding. There's no capex to be spent for budgeted production. By putting those integrating the operations together, we increase our margin and minimise our risk. And the partnership with Eramet adds a lot of value in terms of their knowledge of smelters and our knowledge of mineral sands. It's a pretty good partnership. Thank you.